Is history repeating itself? Could we be entering another tech bubble? With stocks like AMD, SanDisk, Micron, Nvidia up 5 to 10%, what seems to be each and every day, it begs the question, are we potentially entering another AI bubble? There certainly are some similarities between what's currently happening today and also the tech bubble of the late 90s and early 2000s. There's also some key differences that we should really consider as well. Some of the companies that were performing well, the stocks, of course, back in the tech bubble, were not actually earning money. They didn't have any revenue. There was no profits that were to be made. And there was also some fraud that was prevalent during that time. Some of the key differences with some of the larger players today, such as Amazon, Google, Nvidia, Oracle, just to name a few, is that there is true growth and true revenue gains behind these companies. The earnings per share are just exploding, which is why you're actually seeing some increase even with a Micron, which is a memory chip company. Historically, their PE ratio or price to earnings ratio on how it's calculated, the valuation is between 5 to 10, just because it's typically viewed as more of a commodity. But we're seeing these backlogs for years and years to come, where they have sales and commitments going out to 2027 and 2028. So while it may look like a multiple increase today, a price to earnings ratio of 30%, we also have to remember that indicator is actually forward looking. So if you look at it from a 2027 perspective and what the company is expected to earn then, it actually gets us back to that historical PE ratio of about 9. Like I mentioned, there is significant cash flow. These companies, these multi-million dollar international companies, are earning billions of dollars in revenue, especially on these new platforms such as Gemini or Microsoft's Copilot, as well as these new chips that are being developed by Google, right? So there's real dollars and real growth behind not only the growth of the revenues and the profits, but also the growth in the capex, or what the companies are valued at. However, this type of growth cannot go on forever, right? There is a potential that we're entering overvalued territory. Some concerns in the marketplace. We do see that the monthly inflation rate was about 3.8%, so definitely above the Federal Reserve's target rate of about 2%. This is due in part to oil prices increasing, as well as the Iranian conflict, but also the choices of consumers. The American consumer is actually healthier than ever. We're seeing increased spending on food, travel, other types of transportation, also entertainment. And this is also pushing the prices of a lot of these goods, services, and commodities up significantly as well. We are certainly in what is known as a K-shaped economy right now. It's a difference between the wealthier and the less fortunate that we've seen, really. These higher oil prices are really influencing people that are used to living paycheck to paycheck and also don't have a significant amount of savings. But the K part, the upward trajectory, is for us to have assets, right? So you've seen your house increase in price by about 40 to 50%, and that's also increasing these inflation rates. You've seen your portfolio probably double or quadruple over the last 10 years, right? With the S&P 500 being up about 331%, as well as other types of commodities and different assets such as that. So even though we're seeing that price appreciation, we're also seeing the appreciation in our assets, which hasn't really changed many middle class and upper middle class Americans' spending behaviors quite yet. And as I mentioned, the S&P 500 is up significantly over the last 10 years. Let's go back to 2016. A lot of economists and a few different talking heads on Fox Business News or CNBC said that we were also likely in a bubble at that time, that stocks could no longer continue those double-digit rates of returns that we saw between 2009 and 2016. But just think about that for a second. If you had sat out the last 10 years, your portfolio looks very different than someone who's been invested for the last 10 years. I mean, on a $250,000 portfolio, that's a growth of up to $1 million over the course of just a decade. Now, that is a continuously high rate of return, right? That's averaged about 13.1%, which is definitely above the historical average. But that's why when you come and talk to Frankie and myself, we always reevaluate what your risk tolerance is. Because one of our main jobs is to make sure that you never put yourself in a position that is above your risk tolerance. That's why it's so important for you to come talk to us over the course of the next couple months. We highly encourage you to come into the office. We'll update your financial plan for those Gold Division members and just make sure that everything's still on track. We have seen significant rates of return in the equities market, specifically on our Charles Schwab side over the last 2 to 3 years. So we'll definitely want to see if we potentially want to rebalance the portfolio to get you back within your risk tolerance. Really lock in those gains that we've seen over that time period. So give us a call at 610-440-1700 in order to schedule your next meeting with Frankie and myself. We can go ahead and talk about different topics such as how much AI exposure do you have in your portfolio, especially on the Charles Schwab side, and reevaluating your risk tolerance.